Hey everybody, today is Monday, the 6th of September 2011. This is Brian Shannon speaking. Let's take a look at these markets here. We had a big green bullish candle here today, and I say that as a joke because we did have a green candle, meaning that the close was above the open, but we still finished nearly a percent, with 0.75% lower in the SPY. And these charts, of course, are Realtick, and Realtick is the trading software, the platform, and the charts that you see here each time that I do one of these videos. And Realtick is who sponsors these Monday night videos and brings them to you, so go ahead and check them out at realtick.com. But back to the markets, the S&P 500, as I said earlier, it's just a real mess in here right now. If we take a look at this little trend line off the lows, we have a little bit of order, and we could say that we have these higher lows and higher highs that are starting to become established here. But are we painting a bearish picture that is more of a this prior support acting as resistance? We've got a declining 50, 100, 150, and 200-day moving average. So is this more of a bearish flag that we're forming in here? Obviously, you don't want to get short, at the bottom of these moves and these trend lines. And going into buy is not a certainty either. We saw today quite a bit of volatility. We saw an initial bounce, but we came back down through VWAP, tested that a little bit, and even in the afternoon, I mean, this is a big move lower here. It seemed as though we had a nice steady stair step higher, and then we just kept dropping. But of course, the buyers came back in at the close with some volume as well. And the interesting thing is, for the S&P 500, we closed right at, or almost right at, the 2-day volume weighted average price. So that is the average price between Friday and today. So these 2 days, basically, we close right at the average price. Again, these charts are a mess. It's really difficult to say, as people have said, well, we've made a double bottom, or that we're at making a triple bottom, or whatever. We're showing a lot of indecision here. Even on the shorter term time frames, it doesn't become clear. As we get these gaps in both directions, it really makes it difficult to go into anything with any conviction. There's still some good day trade opportunities out there, and some stocks that are setting up for potential bounces and that sort of thing. But overall, it remains a very difficult market to navigate, and really these charts are a mess. So, what will we want to see going forward? Well, we've got this, the level from these levels are going to be important, basically. Right about where we are, 117.75-ish, or 117.50 basically, as potential resistance. We've got that declining 5-day moving average still. That's going to be working its way lower. Let's see if this market does rally, if it meets up and finds resistance at that 5-day moving average. But it's just very difficult to assign logic and order to this market. Although, again, we do have this little channel that seems to be developing, and for now we're bouncing from the lower end of that channel, and that's what we need to make sense of, is the information that we're given, not what we're trying to see and not what we're trying to make a case for, because I see that happen a lot. There's a tendency for people to take a look at the chart and create the image, or the pattern that they want to see. That's not the right way to listen to the market. That's putting your opinion on the market. We need to listen to the message of the market and let the market reveal to us what's important, such as the 50-day moving average in the NASDAQ. We know that last week we had rallied up to that level and sold off hard from there. Now, when we take a look at the 2-day volume weighted average price of the Qs, we see a little bit more intraday order. We bounced from daily S2. We got up through that 2-day volume weighted average price, but it was rejected there once as well. The NASDAQ did finish with a penny gain, so I guess it is a bullish candle, because we had the market above its volume weighted average price, and net during the course of the day, the buyers took control of these markets, but it doesn't mean it's easy by any measure. We're now back to really this getting close to this 53.80 to $54 level, and that's the bigger level that we've been kind of observing here the last several weeks. Really, we had gotten above that, of course, for a few days, and then gone on to test the declining 50-day moving average. But there's just a lot of disorder amongst charts, and that tells us it's time to, it continues to be prudent to take things slowly in here. The bigger level, near term in the Nasdaq, what's been an important battleground has been this 54.5 level. But we're also going to see this declining 5-day moving average come into play as well. So that's something that potentially can offer some resistance. The Russell 2000 was down 19 cents today, and it's trying to stabilize. We take a look at this daily chart. We see that same type of trend line that we see with the S&P 500, and really the same type of channel. So do you want to get bullish at the tops of these channels and bearish at the bottoms of these channels? Price says no. Where has the market come from? Where does it have the potential to go? Meaning, again, that we see these big drops. It's difficult to get bearish after a big drop. It doesn't change the fact that this market is in a downtrend, and it's still pretty scary looking and scary to think about where this market could have the potential to go longer term. We could be seeing down near $60 a share in the Russell 2000 and the SPY. As we know from the 2009 lows, we've so far found support at the 38.2% retracement. A drop down to the 50% retracement and 102 level doesn't seem unrealistic. So keep that stuff in the back of your mind when you're looking at these 1-minute charts and having good day trades to the long side, is that they're just day trades. The semiconductors rather did make a new low here, so they were 1 penny lower than what they had seen 3 weeks ago, 2.5 weeks ago. And from that level, that's where basically they shook the tree pretty hard. The market made that lower low, took some stops there, and again by 1 penny. And then we had this green candle with the market finishing right up at the highs of the day. Just because we see that we made that low first thing in the morning, it doesn't mean it was easy to make money on the long side. It was very choppy up through about 1 o'clock in the semiconductors. Buyers did finally come in, but we had this. Again, that's a pretty deep pullback for an intraday move. So we're still, at best case, starting to show some neutralization in these markets. But when you look at those weekly charts and you look at the direction of the 10, 20, 30, 40 week moving average, it says guilty till proven innocent. Take this thing treat this market very cautiously. If you're going to swing trade, go ahead and try and buy some, I suppose, at the bottom end of those channels if that's your within your comfort level. But you have to do what's comfortable for you and realize that these gaps that we're seeing really can mess with you the next morning. Financials, had been beyond a couple days really pretty much in this range, 12 to 13, $13.40. We're down to the low end of that range. It started to bounce in here a little bit today, but still down 1.75%. Still an ugly looking weekly chart. Nothing really to be bullish about with these markets. The markets are going to either scare you out generally, or they're going to wear you out. And right now we've gone through a pretty scary leg lower so far, but this doesn't mean it's not going to be similar to what we saw in 2008. We could see something similar to that. Don't think that it's not out of the realm of possibility. This market, all of these markets still have a lot of reason basically just to distrust them, and I'll leave it with that. Thanks.